In this episode, we sit down with Matija Djolic, co-founder of HtAG Analytics, and we're going to explore the growing role of data in property investing, what's useful, what's misleading, and how to cut through the noise. What are the common mistakes investors make when relying too heavily or too lightly on data? Do timing, trends, and context matter more than most people think? We'll also dig into the challenges of interpreting suburb-level data and how investors can make more informed decisions without becoming overwhelmed by the numbers.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
Hi, I'm Chris Bates, mortgage broker, currently ranked number 3 in the MPA Top 100 Mortgage Broker Awards. Before we get started, everything we talk about today is not personal advice, and we recommend you engage the services of a licensed and experienced professional.
Our guest today is Matija Djolic, co-founder of HtAG Analytics and a data analytics coach who has worked with thousands of investors and buyer agents over the past 7 years. With a PhD in organizational psychology and a sharp eye for meaningful patterns in both qualitative and quantitative data, Matt brings a nuanced understanding of how to make smarter property decisions through the power of analytics. Now, we are definitely looking forward to this conversation. So thank you so much for joining us, Matt.
Thank you, Veronica, for that wonderful intro, and also, guys, for inviting me. Really appreciate it.
Matt, it's good to meet. I mean, HtAG as a name, it's an interesting one, right? Higher than average growth. I mean, before we sort of get into the guts of data-driven property research, I'd love to just sort of unpack why you went for that name and the philosophy behind what you're trying to do.
Let's start at the beginning. We started as property investors, Alex and myself, essentially me first. I didn't know Alex back then. Started researching, going to seminars, trying to collect information. And I realized that there was a lot of info, but it was across many sources. You couldn't organize it into a single platform. There were a lot of trends missing in data. I remember back then I used to look at Your Investment Property magazine at the back and look at the isolated view of metrics that are provided on each month. I met Alex. He's a software engineer, used to work for Westpac, and we started producing something for ourselves to really pinpoint and tell us which areas will grow and why. The key thing that we try to do is actually connect information and data points and metrics into a narrative to increase the probability of a particular outcome and sort of reduce opportunity costs. So that was, I guess, the basis of the name and how it was informed.
I mean, it's higher than average growth. When you sort of think about that, is it to the Australian property market? Is it to the local market? You've also focused on growth, which we also align to. I mean, because I do think it's a good name, actually. It's actually, I think this is what a lot of investors should be focusing on, is how to actually outperform. But how do you measure it and how do you think about it?
Is the question, what average?
Yeah.
So, yeah, absolutely. Yeah, I mean, you can't encapsulate the nuances of an industry within a single name. I think that's what the first thing that we have to say. But I guess the thing that we do or we'll try to do well is we always say that research must be driven by the individual brief. What growth means and what growth you can expect from a particular area, at what rates, at what timeframes, all depends on the individual purchase brief. And we usually define individual purchase brief as an answer to 4 or 5 questions. Essentially, what is your budget? Because budget essentially delineates the boundaries of possibilities. You can have 300K to spend, but you can't expect 8% average growth annually compounded over 15 years. I mean, you can't buy a Volkswagen and expect a Ferrari. It's as simple as that. Now, the second thing is, how long do you plan to hold the asset in your portfolio? So, for example, if you plan the asset in your whole portfolio 10 years, you will consider different indicators or maybe different trends that if you hold the asset 5 years. The third question we ask is the equity extraction timeframe. So when do you essentially plan to extract equity into the subsequent purchase? Now, this needs to be asked in the context of the term responsible investing. First is sort of nudges the individual to consider how they want to build their portfolio as well as their levels of serviceability, but also in regards to growth targets. Okay, what growth targets do we want to achieve within particular timeframes in order for us to be able to purchase additional assets? Now, this question is important, but in unison with question number 2, how long do you plan to hold the asset in your portfolio? Because I see a lot of irresponsible investing happening where clients are put into areas that can generate substantial amount of return up front, but then that compromises the latter return. And inadvertently, when the area reverts back to the mean or the growth subsides, you have essentially lower annual averages across a decade. And then the fourth question that we usually ask is, what is your risk profile? Because I think risk really should be addressed. And it's inadvertently linked to question number 2. What is your asset hold time frame? Now, why is it linked to question number 2? Well, if you're holding the asset long term, just by the nature of time passing, the more you go into the future, the more uncertainty you bring upon yourself, which means that your risk profile should be inadvertently low. Areas that have higher risk have higher exaggerated levels of volatility, and volatility equals lower annual averages. So we sort of force our clients or our members to answer those 4 questions and to really think about investing in the context of what they're trying to achieve.
Question for you before you kick off. So if you ask somebody what their risk profile is, are you asking them straight up, what's your risk profile? And they go, oh, I like high risk, or I like low risk. Or do people that say low risk, do they understand that short-term sugar hit of capital growth in a volatile area is actually highly risky? Because that doesn't feel risky to somebody who's borrowing a smaller amount of money or buying in an affordable location that's got evidence everywhere that prices are rising.
Great question. Absolutely. Now, there is a process, an onboarding process. And in addition to the HtAG platform, we also have the mastermind community where we teach all these notions and concepts. Now, different individuals define risk in different ways. At HtAG, how we define risk is anything that's an impediment to a deterministic outcome in property investing. And there's 2 essentially, capital growth or cash flow, or a variation of both. So we quantify risk as anything that is stopping us from achieving certain amount of returns within a particular time frame, whether that's cash flow or capital growth. And it's usually segmented in 2 different domains. The first one will be the economic domain, which speaks to industry diversification, dominance of mining and agriculture, and some other aspects such as hold periods, socioeconomics, etc. And then the second one, which is negative environmental effects, is the exposure to bushfires and floodings, because not only does that diminish the participation of investors within that market, but it also increases your holding costs should you invest in those markets. So the question is relevant in a sense that, how do we quantify risk? What does it mean? But we sort of, through our onboarding process, we educate our clients with respect to what we mean by it. You made an observation about volatility and short-term timeframes, and I think that's pertinent. Now, for example, if your risk profile is high, understanding how we quantify risk, that means that your investment timeframe should inadvertently compress. And I would suggest that. Now, you can do whatever you like, but I would suggest that you compress the investment timeframes, and you can potentially trade assets or property. I mean, that's not my suggestion, but you can trade them in a sense that you can enter higher risky areas, take advantage of the growth, and then sort of exit. Again, we're speaking in terms of probability, not certainty. But I always say, if your risk appetite is higher and you want to generate substantial growth in short periods of time, then your time frame should be inadvertently smaller, because if you hold the asset in that area long term, everything's going to get evaporated anyway.
You know, obviously that's the strategy, right? That's high risk, but it's also high risk when you enter these markets, and, you know, the cost to sort of transact in property is just much higher than, say, shares, right? You can buy and sell shares for dollars rather than, you know, maybe up to 10% of the purchase price when you add it all up. Like, how do you sort of deal with that? And how do you sort of deal with trying to enter the party before no one else is there and then exit the party when everyone else is still buying? Like, how do you, I guess, deal with that in terms of your clients?
What we're actually seeing in the industry is that the industry is changing a little. I do think that it's because of how professionals approach it. We do see a lot of more trading of property in shortened timeframes, and I do think that Perth is the culprit there. Nothing against Perth, but I think because we're attracted to the shiny coin as individuals, what we do is, okay, let's find the next area that's going to generate us 100% return in 4 years and enter and exit. And if it's going to generate 100% in 4 years, then you can sort of absorb, you know, the selling and acquisition costs. Now, it goes towards the domain of speculation. The more you stretch that, you're going towards, you know, into speculating what is going to happen. Now, how do we increase the probability that something like that would happen? Well, essentially, the growth equation is very simple. It is reducing supply and increasing demand. I just received a text message from my mum. She was trying to source that Labubu doll or phenomenon. I don't know if you guys heard about it. If kids are going nuts for this, you know, little doll. Anyway, they increased the price from $100 to $110 since yesterday. And I know why they increased the price. Essentially, it's a perfect example of how property markets move. If you have severe supply scarcity established in a particular market, plus very high levels of affordability, and if demand is increasing, well, I'm not going to use the term guaranteed, but, you know, you're close to guaranteeing the price growth. Now, the next question becomes, okay, at which point are we entering the cycle? You know, you can have a reducing supply and an increasing demand, but you can enter at a peak of a hotspot, such as Townsville, for example. Now, the expectation needs to be set right in that instance if you're dealing with a client and say, Mr. Client, you'll generate potentially 30% growth in the next 2 years, but you have to know that thereafter it is going to subside. So I'm a very big fan of always giving pros and cons and explaining to clients what they're entering into and what the expectation should be. Can you time an entry into a particular market when it's increasing? Yes, you can. I believe you can. And this is why the equity extraction timeframe as a question is necessary in my view. And how do you do that? Again, it is the same thing. You need to have a severe supply scarcity established at very high levels of affordability, and maybe short to midterm demand, you can see the trends improving. Now, it's not a guarantee, but the probability is higher.
You've also got to have the temperament to be able to sell at the right time.
Exactly. So that's the front end is to enter.
Yeah.
The back end is when do you exit? There are certain indicators that you can use to give you more information about that. But as I say always, again, I think that comes back to risk. I want to stay away from speculation because of the liquidity of property and the liquid nature of the asset. We're actually blessed. It is very hard for me to time my entry and exit bottoms and tops in crypto and shares. So I think the fact that it's an illiquid asset and the trends are semi-enduring, we can take advantage of that and benefit from it. However, when it comes to exiting, you're right. You never know when to do it. And however, there are certain elements, like for example, I look at substantially increasing vacancy rates. You're usually seeing markets oversaturated with investors, and Perth is a good example. Some areas you see dramatically rising levels of vacancy rates trends, both short-term and long-term. And you see a lot of rising levels of affordability. Now, I always say, think of affordability as, an elastic band. Your body can stretch it until your physical constitution can't hold anymore, then it compresses back. And when areas encroach into that territory of unaffordability, it's not guaranteeing that they're not going to see any growth, but you're already creating a friction point. And when a friction point is created, considering the 2 times larger lending cohort is the owner-occupiers, and if the property is not affordable for the owner-occupiers within that suburb, then you're diminishing the purchase power of a very large purchasing cohort. Yeah. And it's another tell sign that I would use to say, okay, something's wrong here.
Oh, I've often seen that. I've often seen that investors can push prices up in the short term, but obviously owner-occupiers push it up in the long term. And when you've got a lot of investors piling into a particular market, then you've got this sort of rapid increase. And if those investors, it gets to a point where, like you're saying, the unaffordability and the vacancy rates, and so because they're often brought in by yields in the first place, and then that doesn't add up, the sums don't work anymore, and although they'd migrate somewhere else, then that is going to cause, by virtue of itself, going to cause a hole in the market. This is interesting from my point of view because I look at the great availability of data to everybody these days, right? So there's data-driven buyers agents, there's platforms such as yourselves that consumers can access, and lots of consumers are interested in doing their own research. Everyone's an expert when it comes to property, have been for, that's been the way it always has been.
I think everyone's an expert in every topic nearly.
Well, particularly property. And True. If I was a doctor and I went to a barbecue, I'm sure I wouldn't have a lot of people telling me how to do my job, but I certainly do have lots of people telling me how to do my job when I go to a barbecue. But I'm interested what your perception is of this accessibility to data across the board. What has that done, do you think? What impact is that having on the property market? Because it does seem like our patterns are changing, and you could argue that it's because of external macro environmental forces, or you could say that it's coming from within because structurally the way buyers are behaving is changing. What are you seeing in this space?
Yeah. So I'll give you an example. I think we're the only SaaS business that has built a business on the basis of complexity, not simplicity.
Right.
So usually SaaS businesses need to alleviate friction essentially to have a sustainable business model. And when it comes to property, I think that's what's the problem, and data as well. Now, we have a mastermind community where we teach data analysis and data patterns. Now, as I always say, property investing is a behavioral science. I mean, on surface level, it is a game of finance, but deeper down, I think it's a behavioral science. The problem with that is we need to all have an understanding of what each and every metric represents. Not only that, how do you connect metrics into a narrative? For example, if we see a reducing vacancy rate, that there's more demand for rental properties. If there's more demand for rental properties, rents increase. If rents increase, yields increase. If rents increase at a faster pace than property prices, yield will increase. So this is like a simple example of a connection. Now, I believe in triangulation, and triangulation means looking at an area from multiple angles, especially if your brief is very particular. So where the complexity emerges is that you have an individual brief that has its own goals and desires and needs and wants of the individual, which means that the metrics that you're looking at inadvertently change in significance. If I'm investing in a cash flow strategy, then I'm going to place primary significance on yield, rental increases, and vacancy rates, and other metrics potentially take a back seat. Now, it changes if you're investing in growth. Now, what I want to say is that the complexity exists. Now, number one, there is a hierarchy in metrics that we need to understand and address. I think that what people do wrong is that they assume that each and every metric is created equally under the sun, or a data point. You have more direct representations of demand, and then you have proxies to demand. And we need to understand this. And if we don't use this right, we are inadvertently increasing opportunity cost. Now, this is the problem with data use, in my view. And again, coming back to complexity, I think people need to understand what each thing represents, and they need to think about how that reflects in response to the on-the-ground behavior. And then understanding that they need to connect things into a logical narrative that increases the probability of an outcome. And that's what's missing. The problem with saying I'm a data-driven buyer's agent or professional and individual is that first, it's this term that's thrown around like AI these days. I'm building state-of-the-art AI and I'm going to solve all your problems. It is a marketing campaign, a shiny brochure that it's interesting that whatever I see online these days, and I'm getting more and more upset as time goes by, that I can't really trust anything these days because, outlandish statements. That's the problem. And I think to solve that problem, you really need to understand what things mean and how can you use them. And this is why complexity is necessary. And this is why, Veronica, when we started, for example, we had the platform. At the time when you and I were chatting on LinkedIn, we just had the platform. And then I realized that people are looking things in the wrong way. Now, another thing is the paralysis analysis element. People will do a complete analysis involving 20 or 30 parameters, and then they will find one that doesn't really impact their outcome, and they will focus on it and not make a decision. So that's on one side of the equation. The other side of the equation is trying to reduce the opportunity cost and find the right asset or the area for you, which implies that there are variations in data sets. There are hierarchies. There are different timeframes, and you need to layer them accordingly in order to have a clearer idea of where things are heading. In addition to the platform, really realize we need to create the mastermind community. Now, I'm not a buyer's agent. I don't pretend to be, but I'm very good at pattern recognition, understanding how things happen and how things work, because I'm sitting behind the data set for a long periods of time, and I can also test it. And this is what we teach in Mastermind. And I always get, by the way, I get people asking me, why does it need to be this complex? I say, well, mate, if you're spending more time searching for an Airbnb than actually trying to find an asset and outlay 500K plus, you got a problem. And especially if you're doing that for your client, you got a problem. Things need to be complex because you need to explain your position to your client. You need to explain both pros and cons. It's not always pros. You need to display both pros and cons and determine which one you're willing to compromise on, which one you're willing not to compromise on. So that's the actual inherent problem. And the industry, coming back to the changes in the industry, I'm not sure, honestly, whether it's changing because there is an accessibility to data, because I still see decision-making done on the basis of social media posts. And, Townsville is the next hotspot. I go, for who?
Yeah.
Under what brief? For what time frame? So, for example, when people promote areas, I never see an individual promote an area and say, this is a good investment location, and this investment location is good for these types of individuals. You never see that. You see, we found the next hotspot. Let's go into that hotspot. And I'm going, hold on. And even debates about areas. I remember when Perth was booming, I had some negative comments about it. And, you cause a witch hunt online essentially about it. But I always say, Perth is not suitable at this point in time for an individual that wants to generate X in 10 years.
What's important about that, Matt, is that because there's so much increasing use of data, particularly by buyer's agents who buy in bulk, right? If they're all using the same metrics and all interpreting them the same way, and also if the layperson can access various data houses and various reports or whatever, and they're also doing the same thing, now, all these
self-fulfilling prophecy, you mean, yeah?
Well, yes. And if you ask any of these buyer's agents, they'll all very humbly say, we don't buy enough to move the needle in any particular area. But then you talk to local sales agents and they'll say, well, yes, they're buying, 50 a month or 100 a month in this area. Yeah. So you think, well, in a lot of areas, 100 sales in a month is enough to move a needle, right? But they're not the only ones. You know, there's a number of different buyers agents. It's not like they've all got proprietary software and they go, well, one of them goes in this area, another one goes somewhere different. It doesn't work that way. So there's no disbursement of this activity. That then creates a problem because it sort of negates the value of the data, really. It's a selling tool. It's marketing. It's not actually decision-making tool. So you're in that space effectively, like you're playing in that same jungle. How do you come at it in a way that doesn't negate the value of the data?
There's two parts of your question. The first one is the manipulating demand, and I'll address that later. The second part is, say we have one buyer's agent, okay? And they're all putting all of their clients in a single area. They're not investing under the client's brief.
No, of course not. But they often don't. They don't actually care about the brief. They've got they're basically commoditizing, you know, they're selling cartons of milk, you know, like they go, you come to me, you're going to buy a property, it's going to be worth 750,000 or 600,000, whatever. And we're going to buy in a regional area and it's going to have this many bedrooms and blah, 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 and this much yield. It's that there's specified their commodity that they're flogging.
Absolutely. So the way we treat it, and I'm very adamant when it comes to this. So there are two things. When a person asks me, what do you think about area A? I always say in comparison to what other areas and for what brief. So I always force our members to think about what they want to buy under, what kind of returns they want to see, how long do they want to hold the asset, what is their risk profile. I always bring them back to the 4 questions. Now, when they produce an area outside of those 4 questions and they ask me, what do you think about this area? I say, in comparison to what? What are the other areas that you're comparing it to, which pushes that area to the top of the list, and tell me why it pushes us to the top of the list, which is why I said initially, I think we're the only business that has a business because of the complexity. I don't eliminate the friction point. I actually double down on them.
Yeah.
Now, in your terminology, you're always going to have a finite amount of premium assets in a particular area. Yeah. In the same way, you're going to have a finite amount of premium areas for a specific brief. So there will be crossovers because we don't have an infinite amount of selection. There are always going to be crossovers. But if you really analyze 100 metrics, and on our platform, Veronica, for example, we assign significance to every metric on the basis of what they're trying to achieve. Now, you can think about the permutations, and significances range, or the multipliers or weighting scores you assign, they range from 1 to 10 on the basis of the hierarchy of the metric. And that hierarchy is essentially produced on the basis of how likely are they to achieve a particular goal. And if you have a range of 10 for weightings and you assign different weightings and significance in response to what you're trying to achieve, you're bound to produce 2 different shortlists or 2 different ranked shortlists. Okay. There are, again, crossovers because there are premium areas as there are premium assets. Now, on the other side, the other part of your question, I always say to when you're doing research, you're trying to address first things that you can't control. We have 3,500 members. I go to my members and I say, guys, we're all going to Ballarat. Let's all go to Ballarat. We'll manufacture the growth. I'll look great. Everyone's going to give me high fives on the street. The problem with that is that is speculation and doesn't have steam, because sooner or later I won't be able to control the entire cohort, and I don't know how they're going to be behaving when it comes to selling. The second thing is that even if I control the demand side of the equation, I'm still not going to see any growth if there's rampant supply in that area. So, for example, when we're building filtering algorithms, I always tell people, address first what you can't control. And you can't control the supply side of the equation because the government controls the supply side of the equation. So our answer to your question is, if you're putting all of your clients in a single area, you are doing a disservice to them because you're not addressing the particularities of their brief. And now, sooner or later, you know, time is on the side of people who try to do well. You know, sooner or later, people will realize, and it's happening actually, people will realize, okay, I bought in this area, I was promised this, and I got that. Now, does it rubbish the industry?
While, though.
Absolutely.
It takes a while, doesn't it? And look, let's face it, it's not good business to give good advice. Good business is to commoditize this and push everyone into the same area and, you know, conserve your costs.
The good business is to sell the dream. Absolutely.
Yeah.
And that dream doesn't correspond to reality. You know what? I do really think, you know, we discussed this as well previously. I think there's a lot of interest coming to the space. And, you know, I think that the space is a little bit tainted because of certain actions. However, I am a firm believer that when there is a lot of interest coming to the space, those who do things right stand out like a sore thumb. It's just a natural progression of things.
When you go through those 4 questions, I think that's really important. I think also, have you considered alternative strategies? I think that could be a question because people do get very pigeonholed thinking about property, right? They haven't even thought about upgrading their home or, selling a property to buy another property or putting money into shares versus property. There's always other strategies that people just, all of a sudden just go property. And how does this fit into your longer term plan, right? Like, yes, you do this for your short term, but then are you then going to go and buy again? Can you even borrow there? Are you going to be working? Have you got capacity there? Like there's a lot of depth that you got to go into to think through what's the right move. And I'd love to pick your brain on what are the assets. I think they're going to spit out 3 different scenarios. I might be wrong. You might have more, but I want to buy and hold long term. What's your budget? Will then determine where you're going to buy long term, right? Because to get a good asset long term, I'd love to know what your metrics are. Then you got the people who want cash flow, which, I think we could talk the challenges in buying resi property for cash flow and whether that's the best asset for cash flow, right? But these people that are going for, I want a lot of growth, I want it short, we absolutely agree around behavioral science, right? And that's what Veronica's question was before, right? So, because you do have to sell, like, where do these people get it wrong? Because you're right, I think there has been a shift in investors in the last 3 years, and you can see this through all the data, where people have gone from, I'm not buying and holding, I'm buying and selling, and I'm going to keep trading property. And where do you find that the biggest mistakes that these people are going to make? And from a behavioral point of view, where do they get it all wrong?
It is their decision how much risk they want to adopt. And it's a suggestion that any sane person would wear them against if there are other alternative options. Like you always want to layer your portfolio, hold it long term, make a more responsible decision, etc. But some people want to go in and out for whatever reason they do, and there are certain things that they have to consider. But as soon as you adopt more risk, you have to understand that you increase the unpredictability of an outcome. And then also you have to deal with the back end of a decision on when you're going to sell. Now, there are alternative strategies. I personally solve the problem of market momentum and opportunity cost for residential investors. So I would even assess individuals, let's say, current portfolios from, an amalgamated perspective and then funnel down to see, what is the potential for steam, et cetera, and all these other things. But whether that's better placed than placing it into other asset class, it's not something that, not only am I not licensed to provide, but also it's something that I can't suggest. There are alternative strategies where people go in and renovate and sell off, and add value, use the room disparity and insert another room to generate some equity at the onset. Let's say if the area is lagging and then they sit on it, if the area has long-term potential. Bottom line is, I always say this, I try to give as much information as I can to the individual for them to make an adequate decision. And if you're investing in short term, I have to tell you what that actually means. We can go to Gladstone now. I can buy in Gladstone and I'll generate 35 to 40% in the next 4 years. That's all good and well. Potentially it will give you sufficient equity for you to absorb the acquisition and selling cost, whatever it is, and you can exit. Now, when are you going to exit? How are you going to do that? And is that something that's really suitable for you? It's a decision that you have to make, but it is my responsibility to just give them the information that they're dealing with a lot more unpredictability, I would say. I do think, as I mentioned before, that the problem is the returns that people are generating in the Perth market. And this is what people also don't understand. When I say people, some people, you can't expect mirror effects in one market in another market. You can't expect returns in Perth to be replicated across Melbourne and then to be replicated across Brisbane, across different timeframes. It is impossible. So when people come to me and say, find the next Perth, what I say is, I'll find you the fastest horse, but that fastest horse might generate 7% growth, not 30, because that's what the market is providing you at this stage in time. By telling someone that it's going to be 30 or 40%, it's nonsense. It doesn't happen. And Melbourne is a perfect example. Now, Melbourne is branded as a hotspot, or it's getting there. Will Melbourne generate the same returns in 4 years as GCC Perth? No, will not, because dynamics are completely different. You had much higher levels of affordability in Perth, dry powder sitting on the sidelines, very high socioeconomics, which led to, and by the way, 15 years of stagnation, which increased the affordability in and of itself.
Of course.
So dynamics are completely different.
But do you think that someone go for 30, 40% in Gladstone, right? Like, I'm just doing the numbers, right? And I go, so what's the purchase price roughly someone in Gladstone? Is it 500-ish, maybe? I don't know. What would be an entry price? See. Let's just say 500, right? You've got stamp duty. Most of the time, they might even be paying a lender's mortgage insurance. You might have to pay a buyer's agent, 10 grand, 15 grand if they're using a buyer's agent. I reckon your purchase costs are probably going to be close to 8 to 10% to sort of enter, right? Then you're going to have to sell it one day. And so even if you made 30%, you've lost 10% straight away. You've maybe lost then 3% to sell it. There's going to be some type of sunk cost, sometimes some maintenance. You're not going to make much from a cash flow point of view because even if you do, you're going to pay tax on it. And so you might make a 10% gain, right? Or maybe even a 15%. Then you're going to pay 25% capital gains tax on that. So if you get it right, a 30% return is only after tax, like an 8% return. So, and 8% return is over, 3 or 4 years. Then you've got to take that money and then go and re-enter the market. So do you think that investors really understand the after-tax cost and the opportunity cost of maybe not doing these buys and sells, right? Because, making an 8% return over 4 years or 3 years could be made by getting 2% return on another property, right, per year. How do investors think about this?
Absolutely. And that must go into the equation of decision. So they need to put pen, and I always use this term, you need to put pen to paper to see whether it's meaningful for you. And you need to do all of these things and engage a buyer's agent to do it for you.
Most can't, Matt. Most buyer's agents can't. And also most buyer's agents, that old thing about, if you've only got one tool, then if that tool's a hammer, everything looks like a nail. Every problem looks like a nail. And that's the problem with going to buyer's agents for strategic advice. Most don't think strategically. And also, when you've got the data-driven buyer's agent who claims to think strategically, and yet, they really have, I guess, in many cases, a very flawed approach to data. And what I want to talk to you about, though, is if you talk about Perth, that's a city. If you talk about Gladstone, that's a suburb, right? So they're two very different things. And data works well in the macro when you aggregate it and you're looking at patterns, right? But when you, like you said, you're skilled at pattern recognition. When you get into a suburb level, the patterns start to be very unreliable or untrustworthy. So how do you go about analyzing at suburb level? Or is that not something that you do? Is it sort of you get to region, if you like, then you got to get on the ground and boots on the ground to actually do some qualitative research. Is that what you suggest, and how do you go about that?
Yeah, I suggest both. Now, the first thing is that we provide analytics on suburb level, whether it's, SA1 level, essentially. Now, when it comes to accuracy, you need to determine how you're going to group the data points and what's going to be the velocity or the volume of that data points to extrapolate a discernible pattern. And by the way, every data representation needs to have a banner of high, medium, and low accuracy. You need to provide to people that on the basis of the volume that you've aggregated or accumulated equals medium confidence because of the volume.
Yeah.
So you can group data on if there is sufficient purchasing pattern on street level or the suburb level, sub-suburb level. You can group data in different domains saying socioeconomics of this sub-suburb level are X. This is where public housing is. This is the renter to owner ratio in this part of the suburb, et cetera, et cetera. Now, the compounding of good decision making. The beautiful thing about recording is that we're recording data more and more, and the more data that you record, the higher volumes that you have, the more accuracy you do have. Now, that accuracy is varying in and of itself, as I mentioned before. It can be very high accuracy. You can have 20 purchases within the same 3 streets, essentially. It gives you a sufficient base to understand, okay, this is what it is here. Again, it's a probability. It's not a certainty. However, within that 3 streets, you can have options that vary 150K. This is where, combination of boots on the ground with buttress with data works well in a sense that because it cuts your research time. So accuracy is important. Accuracy is based on volume. If you have one data point in a particular region and you're going to say, and this is why I say, for example, let's say on the suburb level, I have one cell now and one cell in 3 quarters or in a quarter. And then how am I going to determine typical price or median value for that, or even the days on market? Go average? You can't do it.
I'm on a personal mission to help more people make better property decisions. Most people don't realise that they can cost themselves hundreds of thousands of dollars over the medium to long term when they make property decisions without all of the information that they need. And what I do is help people with tricky real estate problems, which often masquerade as simple questions like, should I sell my investment property because the interest repayments are hurting? Or should I buy before I sell? Or the other way around. You can connect with me and access all of the tools that I've created to help you make better property decisions at veronicamorgan.com.au. And there you will find resources for first home buyers, details about my buyer's agent mentoring program. You can connect with my Sydney-based property management and buyer's agency teams, Australia-wide vendor advocacy, or ask me for introduction to the small group of buyer's agents that I would personally recommend across the country. That's veronicamorgan.com.au.
If you're looking to buy your first home, thinking of upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and, importantly, get the finance right. Reach out via my website, alcove.com.au.
So here's the thing, though. With property, scarcity is one of the things we look for.
Yes.
You know, so when you see high sales volume, that in a way is a red flag to me, because I think, well, okay, why is everyone selling? What's the deal?
But sale is accompanied with a purchase. If somebody's selling, somebody's buying.
Yeah, but even so, therefore, who's buying them? Could it be the investors all coming in? Of course, the sellers are confident because they're getting more than they really should be getting for the property. So that's what I mean, though. You start seeing a lot of trading, and I prefer to see less trading. I prefer to see scarcity tightly held. These are assets that are underpinned by lots of people who've got lots of equity and lots of owner-occupiers. You know what I mean? So you talk about metrics. That's the metrics that are in the vacuum there. You know, that's in the dark.
Absolutely. Scarcity doesn't preclude accuracy, though. So what I mean by that is that when you look at data or accuracy, you don't look at an isolated instance. You must look at it at a large time span and look at the patterns and see what happens. You have a lot of areas that have one house for listing and supply scarcity is severe, which is what allows that house to grow in value. We didn't get there with only one listing for 10 years. That area has grown in value because there was an exchange. I mean, at a point in exchange, we have an opportunity to increase the price. It sort of, relates to volume. Now, it doesn't mean that you have to have a large volume always in this month, but to determine high accuracy, you need to look at a large span of time and to see that there's more participation in that market and therefore a proxy to opportunity to increase values. Now, when I say greenfield sites, I mean new areas. Yes, there's no listings there, no participation, but looking historically, you can't accumulate data to see whether that's an anomaly or whether that's a continuous pattern. So I absolutely agree that if the area is in high demand and you have one listing, you're on a winner. But it doesn't mean that the data accuracy is low because of that, because you look at the historical movements within that area.
Well, it depends on what data you're looking at. This is the problem. People are typically looking at short-term metrics. So like median price, for example, is a short-term metric. And it's distorted by the composition. And it comes back to that ability for whoever's using the data to be able to analyze the data.
Exactly. So what I always say this, I'll say the perfect marriage is between an individual that can see pattern. Now, there are people who can see pattern in anything, you know what I mean, more so than others. Now, by the way, our minds cannot compute, 10,000 pieces of information at once, and this is the beauty of aggregating things and putting them in one place. When I say aggregating, I'm not saying removing the nuances. I'm saying just putting it in a type of a system which you can use to make a decision. Now, if you buttress that with a decision-making experience where you know exactly, and this is why we spoke about, boundless buyer's agents, and those who are actually focusing on a particular area. If you have a marriage between tech and an individual that not only knows how to use tech, but can apply discretion, that's a perfect marriage in my view. We spoke about this before. Usually the introduction of tech is framed in the context of somebody is going to be replaced. The AI is coming for us. We're all going to lose our jobs, X, Y, Z, or tech platforms such as HtAG are coming in. They're going to replace buyer's agents. To me, it's a nonsense, by the way. It's a complementary journey in my view, because you're never going to, now coming to accuracy and pattern, you're never going to be able to go all the way down to the individual purchase and the individual actual asset and have a large pattern about that particular asset and its idiosyncrasy.
No, that's exactly right.
But you won't be able to do that.
Therein lies why I think that tech will replace a bunch of buyer's agents, because there's a whole cohort out there that doesn't actually get out of their chair to buy the property, right? So tech can do that. If you're dealing with a local specialist, if the tech points you and brings you to the local specialist who then can get out there and really help you cut through all of the noise to identify the great pockets, great opportunities, great assets, then that's different. But if you're dealing with a buyer's agent who doesn't know an area, doesn't go to the area, doesn't inspect the property, then I actually do believe tech will replace that. And it should, and bring it on, in my view.
Yeah, I mean, as I said, to me, it's a marriage. And I do think that where we are heading is that everything's being datafied, in a sense that everything's being collected and everything's being quantified. I do think that if you can use it in the right way, it can really help you and it can really shorten the time for research in certain domains. But if you compound on top of that your experience and you try to, and I mean, negotiation is an aspect. How is tech going to negotiate for it?
Well, it's tried. There's a lot of prep tech that has been a lot of dollars thrown at solving the negotiating for property issue.
The AVMs of the world, I mean.
Well, yeah, that's part of it. But I'm more at the actual negotiation platform. And they come at it from an issue, not so much that, tech is better or working out price, but more the fact that there's a common belief you can't trust real estate agents. They're like, well, we'll solve the problem. The problem we're solving is that you can't trust an agent. And so therefore, we're going to put a platform out there that allows buyers to trade transparently. And so there's been a lot of these platforms that have been created over the years, and none of them have really solved the problem because they haven't defined the problem properly. They misunderstand it, in my view. And they've failed, right? Because also what happens with the agents? When it's a hot market, they turn the transparency on. When it's a quiet market, there's really only one buyer interested, they turn the transparency off, right? So it's like a simple gamer. Like, you are not going to get an agent to employ this technology, right? And they're the ones bringing the property to market. You are not going to get an agent to utilize the technology if they are unable to adjust the transparency when needed. So it goes back to that. There is a problem with transparency and trust, I guess, but it's also because buyers don't respect that transparency.
I'll tell you a story about that and a story about HtAG. So when we started off, Alex and I thought, okay, we're going to eliminate personalities from the whole process. But the reason why we wanted to eliminate personalities because personality equals bias at that time, in my view. And the reason why we started is I personally saw some atrocious decisions made around me through certain professionals, and which sort of, ignited the fire in me to actually produce something. And I said to myself, okay, let's not have personalities at all. It's just data. The problem is that people like dealing with people. Okay. That's the problem. People first and foremost like dealing with people. Now, I have a business that should potentially have 15 employees, but we have 4. And everything else is automated. The AI takes care of all the additional burden. Now, is that ethical in my view? Or am I actually helping the economy? It's debatable, potentially for another podcast, But what I'm trying to say is that you can have the tech solve certain aspects of the process, speed it up and increase the accuracy. But in other aspects of the process, you need and must have a personal touch. Yeah. I had avatars on the website instead of us, because we wanted no personality, no bias. It's just hard facts. Realizing that I need to teach the methodology, that I need to explain to people the connections and all of that. And also people just resonate dealing with people. So that's just the meta level of saying that I don't think that the negotiation aspect is going to be solved anyway with tech.
There's obviously a lot of people that are doing this buying sell strategy, right? Like, if you get it right, you get it right? You pick a Perth and you get in early, you sell it, etc. You make your profit, then you move on to Darwin, or then you move on to Townsville. Obviously, there's an opportunity cost of maybe just buying a buy and hold, which they don't obviously want to often compare, right? Because if you just went and bought a house in a capital city and you picked a house in Brisbane, that would most likely grow as well. And you might want to hold that for 30 years, right? So there's a safer strategy over the longer term versus sort of this transacting a property, because it is so expensive. It goes really well. It's like, A, it's leverage, and B, it's high cost to transact. And so it'll go when it goes well, it goes well. And if it doesn't, you really burn time and money, right? But for those sort of buy and hold investors, right, I would say that Veronica and I are both sort of in that camp, right? Like, we're not going to try to time investment markets. And it's a little bit like in shares. There's a belief that you can, there's market inefficiencies. I can pick stocks. I can outperform indexes, right? And there's been a lot of difficulties for fund managers to do that, even though they've got more and more data than they ever have.
Value investing, essentially.
Yeah, exactly. And sometimes it really works because all the fundamentals flip in their favor and they've positioned their portfolio and they've really captured it. Then the next year they might underperform, right? And so you've got to be really careful. So, but for those buy and hold investors, where do you think the data can help them be better investors? And I guess, a lot of the buyers agents, a lot of the investors that are just buy and hold investors, where are they sort of some tricks and some data points that they should start to think about that they're missing, that they're often not considering? Because, like you say, they're going to a buyer's agent in Brisbane, for example, who knows these pockets and, is just buying in the pockets they know.
Yeah, so from the data perspective, we separate our building of our research algorithm into 3 different domains. So we first address the macro metrics, then supply that market cycle positioning. Now, I won't go into the second two. The first one addresses your question. So the metrics that I would always look at as a must for long-term performance is, and this also depends on the price point, but the first thing that I will look at is the data accuracy long-term. So are there volumes? When I look at the data, can I really understand that this data is not going to oscillate dramatically from month to month or quarter to quarter, especially if you're investing long-term? Because, as I said, the more you go into the future, the more unpredictability you bring upon yourself. The second thing is risk. Now, I make sure for long-term investors that they invest in highly diversified industry towns, and there's also minimal exposure to flooding and bushfires. 2 are different, highly centralized industries, are susceptible to macroeconomic changes. And if you're holding an asset long-term, 10 years or 15 years plus, you're bound to go through one macroeconomic shift that could potentially impact the industry question and diminish the purchasing power. That's item number 2. Item number 3, I look at affordability. Okay, and I think affordability is one of the most crucial metrics that we must consider, especially because the affordability metric or the index that we have specifically talks about that particular suburb. So it's like a mortgage stress indicator for that suburb. And considering that, as I mentioned before, the 2 times larger lending cohort is the owner occupiers, we need to first set the stage right for the owner occupiers to make sure that they have sufficient purchasing power to buy property, okay, within that suburb.
Does that shift though? Like because the buyers in a suburb today might be a medium level couple, right? And then as the higher income couple, for example, double income couple can't afford X suburb close to the city, they sort of move further out. And so the purchasing power of the buyer today might be different to the purchasing power of the buyer in 5 years' time, because the people who are rocking up at open homes and going to auctions, they've got different means, whether it's income or whether it's family wealth. And so how do you sort of measure that when buyers are always shifting, right? And COVID was a great example of that, right? So, often in regional towns, buyers would be locals. And then all of a sudden we saw COVID, right? He said, hey, Sydney incomes are moving to a regional pocket. And so the buyers completely shift, and hence why prices of, how do you measure that?
On the individual level, there are multiple different individuals and variations of where they extract that wealth, okay? But when you're talking about probability, you can't extrapolate a rule from a single individual, so you're forced to aggregate. Now, when you're looking at the suburb level, yes, there are different types of individuals, but you look at sort of a median incomes from that suburb. Again, we're talking about probability. So how do we define the affordability index? So we define it as RBA cash rate plus 2% buffer, medium incomes on an 80-20 LVR, with 50% of those medium incomes going towards repayments against the typical price for that suburb. So it is nuanced, but it's not nuanced to the variation of each individual. It is aggregated at the suburb level. Now, you made a great point.
I think what Chris is alluding to there is shifting demographics and gentrification as well. Like, they will change the makeup of an area. So how do you capture that?
So there's been research published by ABS regarding gentrification. Gentrification is encapsulated in the socioeconomic index of advantage and disadvantage, and it shifts. Now, ABS has done that research, and the notion of gentrification occurs gradually.
Yes.
And lasts decades. So what you usually see is that you see a jump from an ERSAT score of 1 to 2. You don't see a jump in an ERSAT score from 1 to 8. Yeah. 8 being, affluent. Again, timeframes come into play when you're making a decision. Now, there's a sub-question to that. Affordability does shift. And affordability shifts on the basis of the affluence and the price point of the area, which is reflected in the price point of the area and the socioeconomic.
And I guess who's buying there? Like, if all investors are buying there that have incomes from other areas, then that will affect the affordability of an area with a lower socioeconomic index, right?
Yeah, participation diminishes when it comes to the investor cohort. On an Australia level, participation diminishes at the 700K plus mark. Most of the purchases at that range are done by owner-occupiers.
Yeah, okay, yeah.
Okay. So usually 9.99 briefs out of 10 that I get, investors wanting to buy in, 550 to 600K and below.
Yep.
So it does actually diminish. Now, this
But
is why
it does diminish, but actually that makes that price bracket really, really risky, doesn't it? You got first home buyers in the same pool and you've got investors in that. That actually is a bit problematic, I think, people entering the market.
Well, cupcakes. I use the cupcakes example again, or Labubu example. If there's too many buyers buying the same Labubu, I'll increase the price. Now, this is what produces a hotspot to, a lot of people competing for the same assets. And then the question is of sustainability and how that area will last. Now, it's always preferable for me if I'm investing in an area that has 550K or below price point, that area also has very good socioeconomics, because there is 0% chance that an area that's 700K in value will double in a decade with an ERSAT score of 1 or 2 or disadvantageous socioeconomics.
Yeah.
0% chance. I did the research. I can send the research. So, for example, if I'm buying under 550 and as a criteria, somebody comes to me and says, listen, I want to invest in this area long term. So you're inadvertently going to invest in an area that you have to make some compromises on. So there's a reason why it's 550, not 950.
Yeah.
However, one of the things that I wouldn't compromise on for long-term growth is I want to make sure that the socioeconomic standard of the area is higher respective to the comparable areas under the same price point.
Yeah, okay, got it.
It needs to be contextual.
And I mean, on the, obviously locations, how are you thinking about the different makeup of types of properties? Because you can go location of X, but is it always the same? We want to go houses. Do we look at apartments? And do we look at different parts of the suburb? Do we look at the better streets that are closer to the amenity and the quieter streets and not the rat runs, and the better aspects and the better floor plans and the better block sizes? Because I feel like that these are some of the things that, from my experience, seeing clients that have come to us that are working with these data-driven buyers agents, is that, yes, they're going for these, and I guess all these data metrics are saying this is the area to buy, but it's almost like the application of that in the marketplace is just not there. Okay, yeah, I get it, you want to buy in that area, but if you're going to buy in that area, don't buy this property, because it's a south-facing block on a busy road backing onto a freeway with a power pole out the front, and it's 700-meter walk to anywhere. How does that work in terms of your analytics?
And I mentioned this before, we need to compound good decision-making, but it's a funnel-like approach. You start with the brief, you delineate a short list of suburbs that correspond to that brief, which encapsulate or reflect the metrics that we need to look at in order to get us to the promised land. Then we inspect the suburb level, and we try to find better pockets, better areas, better socioeconomics, and you come to a position where you stop, and then the buyer's agent takes over and says, within this great pocket, within this great street, this asset is better. They must do that to compound good decision-making. So they must go from the top or from the brief, if you want to look at that at the top of the hierarchy, they go all the way. There are analytics when it comes to pockets within a suburb to understand where the locations are better within that suburb. And then within that pocket, you have to take over and say, okay, asset A is much better than asset B. Now, I'm saying compounding good decision-making. Will you achieve growth even if you eliminate that last step? Potentially. But you'll achieve less growth than if you do it right.
Yeah, and it depends on the market.
You won't get any argument here. And it comes back to local knowledge, Chris, because I hear this story from sales agents and also local specialist buyers agents about the out-of-towners who use the data to get to the broader location, right? But then end up buying on the wrong side of the tracks. I was talking to a property manager in Orange this week, actually, and she was saying this is what happens. She sees it happening all the time. Then they come to her to manage the property, and they're like, they had a buyer's agent buy them that, and they bought in the troublesome area. I've heard stories in Ballarat, for example, that there's a pocket of Ballarat where the property managers will not, well, the businesses won't let their property managers go there on their own. They have to always have two people go to any inspection at any property in this particular pocket, and the buyer's agents have been buying up in that area. Like I was talking to agents up in Tamworth, and I heard very similar stories, so these are regional areas where a lot of buyer's agents have been buying there, very few of them knowing anything about the area, very few of them going to the area. And so they've got that, they're missing that crucial last step. But I think it's worse than like at odds are you're going to buy an ordinary property. It's actually these buyer's agents that they're using are taking them to the properties that are easy to buy. And that's scary.
If they just look at, so for example, on our heat maps on the suburb level, we have hexagons, okay? And you can enlarge the area of the hexagon as much as you want. So for example, I want 20 data points in that hexagon, or I want 5, or the more you enlarge it, the more accurate it gets, obviously what you're looking at. And if you're looking at pockets, you know, you have some areas that have a 3 better for 500K and a 3 better for 1.5 million. Yeah. I'm exaggerating, actually 1.1. I was looking at Lara.
Yeah.
Just thinking about it now. So if you looked at that data point, just from the price itself, you can see, okay, there's something wrong here. As I said before, looking at the 500K area, there's a reason why it's there.
Of course. But then you've got that myth, that property myth, which is buy the worst house in the best block. Right? And it extends to
renovated, I would say.
Yeah, and that's really what it's meant to be. It's meant to be the unrenovated house on a great street, but people don't realize that's what it's actually meant to be. You know what I mean? So you can just see, I mean, we're just talking about lots of examples where people can misunderstand data. They use it, but they don't use it enough, or they don't put it in context and use it, like you're saying, compounding good decisions. It's a powerful tool for people, but they've got to understand how to implement, how to use that tool. It's like, I heard this saying that, and I will bugger this up, I know that, but it was something like giving somebody a chainsaw and so see how you go. You know, it's like, it can be a very powerful tool, but it can be friggin' dangerous as well, right?
You mentioned something, there are a lot of myths in the industry, heaps. I'll give you from my domain of understanding and knowledge. Like I have people, there are methodologies out there that suggest that if the area has grown 50% in the last 5 years, that area should be discounted or disregarded and it will not grow more. And my question to them is, so where does growth occur? Does it occur? So is it supply and demand that generates growth? So for example, if I have an area that has generated 50% growth in the last 5 years and yet it still has supply scarcity and high demand, it is guaranteed to grow more. The question is, what is the steam? But we'll address that later. However, determining whether something is growth simply from looking at growth pattern in the past, inaccurate. Another thing.
But that's also the same mentality if somebody says, oh, I'm not going to buy in Sydney because it's had its day. It's like it's never going to grow again, you know?
Well, the reason why most of the investors, and I know you're servicing different types of customer profiles, but the reason why the general investor doesn't invest in Sydney because they need to pay, where I live in Southwest Sydney, 1.5 mil for a house.
That's true. I mean that I just said that as one example. I mean, you could say, oh, I'm not going to invest in Brisbane. It's had its day. It's like it's never going to grow again.
I agree. Now, the fact that it's 1.5 mil doesn't mean it's going to grow more, but everything grows to stages. You have stagnation, you have growth, then you have another layer of growth. It goes through cycle. Another one is vacant land. You know, vacant land. It's funny when people talk about vacant land, they inadvertently talk about it in the context of oversupply. And then I ask him, okay, but what is the demand side of the equation? Oversupply happens if there's not enough demand to absorb the new property. Now, vacant land does not translate to building approvals. There's about 5 degrees of separation between me seeing green pastures, that being rezoned, me getting building approvals, then X, Y, Z. You know, a lot of myths. I agree, Chris and Veronica. A lot of myths are there. My personality is that I like to poke the bear. In a sense, you know, I love to talk about these myths forcefully, and I like to change people's minds. Now, some people resonate with that and they like our service. Some people don't, and they don't have to like it. But I mean, me busting myths is not to create perception of knowledge. It's actually giving the information that's correct and dispelling the lies. That's, I think, what is important to me, at least as an individual.
Well, I think we all agree with that as a general philosophy. Right, Matt, that's been fun chat, but now we'd love to hear from you if you've brought a property Dumbo for us.
Property Dumbo, one in particular that stands out. Maybe it's not, you know, dramatic or great, but it was interesting to me. I had a client who I've done extensive analysis with. She was a first-time investor, was very apprehensive about investing, and her family wasn't sure. So she was sort of battling, her husband battling, you know, the perception of her family as well. We did extensive analysis and she went to the bank to get a loan finally. I think the bank manager asked her, where are you going to buy? And she said Cairns. And the bank manager laughed at her and she nearly pulled the actual pin. That was a year and a half ago. I think she bought in Edmonton. For her price point, it was a particular brief. She couldn't afford any other areas. She was trying to enter the market. And I think she saw about 120K return within the last, you know, how many months. Now, again, the fact that she saw the return, again, we had to analyze the long-term perception of it. But what I'm trying to say is that I do think that the Dumbo element of it, not the Dumbo, but I think that the moral of the story is, to the point we started initially, is that everyone is an expert And, it is dangerous sometimes to really, if you do everything right and try your best and, you try to analyze information, you engage an expert and you go through all of it, you have to make a leap of faith in anything. But it's dangerous that everyone has an opinion because they can really stop us from achieving what we need, I guess. So that was a Dumbo.
Yeah, you're absolutely right. Everyone does have an opinion. They could have been pro cans, anti cans, whatever, often not backed by anything other than a little bit of opinion and a couple of anecdotes. So, yeah, it's an interesting one and it's compelling because everywhere you go, as I said, I'm astounded at how many people, as soon as they find out I'm in property, they start giving me advice, which is just interesting because I didn't ask them. And, just like, wow.
Yeah, I mean, when you say cans, for example, I mean, I know a lot of people say, I just invest in blue chip assets. I mean, we can determine what blue chip actually means. But, I invest in blue chip assets. And I go, hold on, mate. If everyone needs to invest in blue chip assets, nobody will be investing a very small portion of it. So you have certain individuals that have restricted budgets, restrictive needs. They want to get on the property ladder. You want to analyze it for them to do the right thing. And they can't invest in Double Bay,
No, of course. And they do need access to good data because, if for argument's sake they live in a capital city, they're going to struggle to find something affordable to invest in a capital city. I mean, you could then argue, should they be investing in property? And that could be another conversation. But the simple fact is the buyer's agent model is broken for a number of reasons. One is because local specialists can only advise on their local area. And as I said, when you've got a hammer, every problem looks like a nail. You go to the borderless buyer's agents and they're not necessarily using good practice and not necessarily using data in the best way. And so you could be put into a sausage making funnel and you end up 5-10 years time worse off. So it is a real problem with our whole system. But then it's compounded by the fact everywhere you turn, you get free advice from people who don't know any more than you do. That's a great Dumbo. Thank you very much, Matt. It's been a really good conversation.
Guys, Veronica, Chris, really appreciate you inviting me. It was a pleasure. Thank you very much.
Thanks, Matt. Appreciate it.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.